Hey guys, welcome to the seventh episode of the series. Today we're going to be talking about leverage and could it potentially harm your account. One of the biggest reasons that Forex trading is an entirely different animal than stock trading or futures trading is leverage. Because of it, Forex is known to having a very low barrier to entry. It tends to enable retail traders with very low capital to start investing in the markets. But what exactly is leverage in forex trading? Is it beneficial to us? Can it harm our strategy? Let's just dive deeper into what leverage in forex trading is. So, in general, leverage is the amount you could borrow from your broker in order to invest. For example, if you were to invest in forex using an account with a leverage of 500 to 1, by the way, leverage is expressed in ratios, such a leverage would provide you access to capital that is 500 times your initial deposit. So if you were to have invested $1,000 into your trading account, you would be able to control an amount of $500,000. Sounds pretty exciting, right? That's how traders have access to much larger volumes than they would initially be able to trade with. And that's why more and more traders are deciding to move into the forex market. So, how does leverage of forex actually work? Let's think of it this way. If you were to invest in merely $1,000 into your trading account, leverage in such a case would come in play by enhancing your lot size. If you were to have an account with a leverage of 1 to 1, meaning that for every $1 invested, you'd need to have that dollar in your pocket. So if you were to enter a position, a deposit that size would allow you to open micro lots, which is equivalent to 1,000 units or 10 cents a pip, with no leverage put in place. Meaning, in order for you to profit from a trade, you'd need at least a 100 pip move to create a $10 profit. Now, if you were to invest the same amount into your trading account but having a leverage of 500 to 1, that would mean that putting aside your $1,000 initial investment, you simply have 500 times that to invest with. In other words, you'd have an amount of $500,000. You'll be able to invest in lot sizes of up to 5 standard lots, which is equivalent to 1,000 units per lot. So, in simple, 100 pip with a standard lot size of 5 could potentially provide you with profits of up to $5,000. Now, keep in mind, having leverage in Forex doesn't mean that you would actually carry $500,000. This is simply an amount loaned to you by your broker. So, if you were to simply invest $1,000 into your trading account, having a leverage of 500 to 1, you simply trade as if you had $1,000. Meaning, if you were to use that leverage and enter a lot size of 5 and the trade were to go against you, let's say, once you hit that $1,000 loss, your account will be wiped out and closed. So, in a sense, you're simply trading with your own $1,000 by having the purchase power of $500,000. That's why traders are afraid of using leverage. It's a double edged sword. You could earn a lot in a short period of time, but you can also wipe your account clean in a matter of seconds. So why would someone use leverage? If it wasn't clear till now, one of the best advantages leverage in Forex provides is the opportunity to trade with low capital. Before, only investors with high capitals were able to create a decent amount of profit. But with leverage, people who have accounts as low as $100 would be able to make very huge returns. The second reason to start using leverage is the fact that it's interest free. If you realize, we've mentioned that the amount of capital received to invest is actually money from your broker. That loan doesn't incur any interest over time. All that requires is that you simply just trade and maintain that initial deposit, of course. So, why should one avoid using leverage? Now, leverage can be a blessing and a curse at the same time. One of the biggest reasons of avoiding leverage is simply the risk of losing. As we mentioned before, when one uses leverage, it's not like having the actual $500,000 in your account. You're just using them as a push to create huge amounts of profits prior to your initial investment. So if you were to have an account with $1,000 and were to use leverage, a simple $50 pip move could wipe your account clean in a matter of seconds. All it takes is 20 pip movements. Second reason to avoid leverage is the revenge trading. The control on that messed so many up. When it comes to trading, it's no surprise that we could have many red days. Hell, there can be streaks too. If you've realized one of the most important factors in becoming successful in trading is the control of emotion. When one simply loses a trade, the emotional hate rises up for revenge. You would simply want to find a trade that would give you a return equal and more to that loss we just had. And how would one do that? By increasing the leverage or lot size in a trade. And where does that lead to? A wiped account. We've all been there in our early days. The third and worst reason of all is a margin call, which we will discuss next. But for now, a margin call is simply a level of account balance that you are required to fulfill depending on your own capital. If you were to go under that level, you would receive a margin call. A margin call is basically when your broker liquidates all your profitable positions in order to maintain that level. He'd basically call you up telling you, hey, you've went under this level and you have to maintain it. We're gonna liquidate all your profitable positions in order to maintain that level. Trust me, it's not a nice call to wake up to. Now, which leverage should one choose in Forex? There are many leverages in Forex. You have 1 to 1, you have 10 to 1, 50 to 1, 100 to 1, 500 to 1, 1000 to 1. There's so many to choose from, but what I can say is this: it all comes down to you. Use the leverage you are comfortable with, but if you want to go into a deeper model, you should consider risk management. If you were to invest $500 in your trading account and planned out that for every trade you would risk a maximum of 2% of your total balance, then this would translate into a $10 loss for a $500 account per trade. In order to maintain such a percentage of risk, we would have to calculate the amount of lot sizes we would need. So let's consider that we were to open a trade. To calculate the lot size, we would need the total amount of pips. If you were to say that 30 pips would be our total breathing room and $10 being our total loss, then a lot size of 0.03 would suffice. Now, don't confuse risk to leverage. I mentioned that example to explain that it's all in control of your hands. But how does it relate to leverage? Well, if you were to promise yourself in executing that kind of risk management, then you wouldn't need a leverage of 500 to 1. Just remove it, delete it, change it. Doing so excludes the factor of actually wanting to use that leverage. It's addicting. Who wouldn't want to see that $10 profit trade turn into a $500 one? How to change leverage in Forex? Changing leverage ratios depends on the broker you have open accounts with. How Forex, for example, provides you with the opportunity to do so yourself. Some, on the other hand, don't give you the option. They typically implement a 400 to 1, 500 to 1, 1000 to 1 leverage ratios directly onto your account, as it seems to be more attractive to traders. Now, in order to change such ratios, you simply just contact your broker with a simple email stating that you would like to change your leverage on account X from Y to Z. Ratios would suffice. They'd answer you very quickly, and it's not like it's not allowed or something. You just have to ask. In the end, leverage is a double-edged sword. It may be beneficial for traders with small or big accounts to create amazing returns, but also adds exponential risk. Traders with low capital of $200 can be easily drawn by the idea of turning that amount into a much greater one with leverage. Now, that may be doable. You could turn that amount into something big, but leverage could also wipe your account clean if not used properly. It's all about control and dedication to the plan. I highly advise you to stick to the relation of risk management and leverage. If you won't be needing a 500 to 1 leverage account, then simply don't use it. Don't even enable such a feature. Emotion plays a harsh factor in trading and can influence your usage of leverage. So, hope you guys enjoyed this one. I'll see you in the next one.